cautious commentary coming in from Accenture. So the top loser on the Nifty today is Infosys. We have LTI, Mindtree, TCS, HCL Tech. In fact, among the top 5 losers on the Nifty, all of them belong to the IT pack itself. Infosys, LTI, TCS, HCL Tech, Tech Mahindra, Wipro as well. So that's the single biggest contributor on the downside. The Nifty Bank is actually outperforming, opened slightly lower, thereafter saw a bit of a pickup and now just trudging between green and red itself. The broader markets, Manappuram Finance has to be the stock of the morning, opened up about 1.2%. But let's see where it goes from here. From a volume standpoint, there could be a bit of an impact, largely because the stock has also entered the F&O band, so we'll keep an eye out on that one. What that has done, however, is taken all the other financial stocks higher with it. Maybe perhaps a positive rub-off of a deal happening in that space. So we have Poonawalla FinCorp, which is higher. Aditya Birla Capital has opened about 1.5% higher. AU Small Finance Bank as well is higher. We have Geo Financial Services, which continues to do well. We spoke about the positive brokerage note coming in on United Spirits. That stock is higher by about 2.2%. We have Geo Financial Services for the third day running, doing extremely well. And we have KEI Industries. All these wire and cable stocks, which had taken a bit of a drubbing yesterday, are seeing some bit of bottom fishing today, with KEI Industries having moved higher by about 1.5%. Senco Gold, for the fourth trading session, the stock has been locked in upper circuit, a 5% upper circuit, making the gains of almost 14.5–15% for this week itself. Defense stocks not doing too bad either. We have Bharat Dynamics, which has opened higher by about 4.5%. BML up around 4% as well. And just before open, we got that news coming in on VA Tech Wabag that there has been a funding announcement of almost $100 million. That stock too has opened higher by about 3%. On the way down, we are seeing a decline on TBO Tech. As Vivek pointed out, there is a block deal out there and some bit of profit taking on names like Shipping Corp, which saw a big move in yesterday's trading session, along with something like a Green Lamb, which goes X bonus in today's trading session. So the mid caps now have recovered. Nifty just about flat, led by the Nifty Bank, pressurized by the IT index. And the broader markets are doing a lot better than what they were at the open itself, for 1,300 stocks in the green, for about 720 stocks which are in the red. So we'll keep an eye out on the markets. We're also seeing some up move on names like Nestle India, some perhaps pick up in the auto space as well. So Maruti Suzuki is up around 1%. Trent is also seeing a bit of a pickup. Shriram Finance is the other one, which is up around 1.3%. Oil prices saw a bit of an uptick overnight. So let's see whether ONGC and Oil India continue their up move. They've opened in the green by about 1%. Let's see how that pans out as well. But Bajaj Finance is one which is doing extremely well. Let's go across to Hormaz. He has a list of all the brokerages that have written on some stocks this morning. Hormaz, Bajaj Finance is the top Nifty gainer right now as we speak. It was expected. What are the brokerages making of this development? I presume positive all around.
Positive all around indeed. Top Nifty gainer of the day, top Nifty gainer so far this year as well has been Bajaj Finance. The key overhang on the stock has also been addressed, right, with the elevation of Rajiv Jain as Vice Chairman and Executive Director for a 3-year period. Anup Saha is now the new Managing Director as well. So brokerages across the board have raised their price targets on the stock. With starting off with Citi, it's maintained its buy rating. It's raised its target to 10,200 rupees now. And it said that the leadership continuity and strategic clarity is now lending more credibility to the seamless execution for Bajaj Finance, and that the concerns around this management transition have now been mitigated. Morgan Stanley too, he had an overweight rating. It had put out a scenario analysis as well. If Rajiv Jain indeed does stay on at Bajaj Finance, it has raised its price target to 10,500 now from 9,300 earlier. It said that Rajiv Jain's continuity will improve investor confidence and the sentiment as well, and the investment thesis for Bajaj Finance is now the strongest among the large cap financial companies, and it also expects the re-rating that Bajaj Finance has had recently to sustain, and also strong returns is what it is expecting over the next 12 months. The CLSA 2 on Bajaj Finance has maintained its outperform rating. It has the highest target on the street, though 11,000 rupees from 10,000 rupees earlier. It said that it is the top pick. The focus is back on fundamentals now with the management transition now in place. The credit costs are near their peak and they should taper down from FY26 onwards, and it is expecting a 26% profit CAGR over the next 2 years. So as many as 5 analysts now expect the stock to cross levels of 10,000 and above. Positive commentary coming in all around.
Positive commentary coming all around. In fact, now as we speak, the real estate pack has picked up. It has been the best performing index all through, all through the week. And now we have DLF, Prestige Estates, all of them picking some pace as well. But let's go across to Prashant and Surbi, who've moved studios for now to get in a good conversation coming in on the markets itself. The team of UBS joined them. Prashant, Surbi, take it away.
It has been a great week for markets, with the Nifty up about 3.5%, the Nifty Bank about 4%, and the small cap index up 6.5%. The big question many are wondering is if this is a bear market rally and they can be powerful when they come, or have we really for sure seen the worst of the downside levels? The other question, of course, is if you believe the time is to be constructive, is what to buy. Financials is one consensus overweight, but what else? Lots of stuff moving around. Surbi and I'll discuss all of this in this special conversation with Gautam Chachoria, Head of Global Markets, UBS Securities, and Vishal Goyal, Head of India Research and Banks Analyst at UBS Securities. Gautam and Vishal, great to have both of you gentlemen here with us on the program. Appreciate your time as always. Prashant, this side. Gautam, as I prefaced this conversation with that comment about is the bottom in, not in, a bear market rally. So let's just get that out of the way, because I think that is the number one question in the minds of, I guess, most who are watching this broadcast.
Sure. Thanks, Prashant, for having us here. Look, from a tactical near-term perspective, it looks like the bottom has been made very clearly. And that's what our view would be from a market's perspective. And the reason for that is very simple. What was driving the market correction over the last few months was valuations and the slowdown which we saw in macro growth and earnings in India. Both of them, after the correction and after the last couple of months, I think has reversed. One, valuations are no longer as absolute and relative basis as expensive as they were. Secondly, the growth slowdown which we saw, the policy actions, both from the central bank and the government of India in the last couple of months, have clearly reversed the direction. So with that in context, market definitely seems to have bottomed out. However, I'll just add a caveat. We will live in uncertain times. Obviously, what happens to global tariffs, global growth specifically, not just in India, that will have an impact on Indian markets going ahead, but that's kind of well known. But market definitely has bottomed out.
You threw in the word tactically. So it's like the caveat there. But do you think tariffs are the big one? That is the big one. So on the second, and so let's just get that out of the way as well. Do you think it's going to be a big one? It's going to be something to be? So they'll go max high tariffs. They've said they'll hand over a number to each country. And India has been mentioned many times as a high tariff country. So they'll hand over a number on the 2nd of April in terms of what's the cost of doing business with each country. And the expectation is that they will back down from that level. So it could be a high number to begin with, and then perhaps negotiations, etc. What's your sense? And how much of a risk is that for the broader market, Vishal? Sorry, that's for Gautam. Sorry. Sure.
Okay, look, for tariffs, we are less worried about how it impacts India directly in terms of what US tariffs are for India, because it's out in the media that they're talking in terms of a bilateral trade deal. So even if there's a tariff which is a shock on early April, it's quite likely that it followed a trade deal and we have a much more equilibrium state, which actually not necessarily bad for India in a bilateral sense. What we do worry about from a tariffs perspective is not the direct impact, but the indirect impact. If the tariffs in general leads to a global growth slowdown, it will affect Indian markets and Indian economy. So that's a much bigger worry for us rather than just the tariff rate which US imposes on India on 2nd April.
Yeah, absolutely. And I think that clarity will only emerge as the next couple of weeks unfold, right? Because on 2nd of April, we'll get a number like the US president has indicated, a number which will be the basis and the starting point of negotiation. And then we'll see how that goes. So it's not quite over as yet. Gentlemen, great to be speaking with you this morning. Thanks for joining in. Vishal, I wanted to get to you. So the big headline from Gautam has come in that the bottom has been made. Now let's talk some numbers as well. And he alluded to how the actions from the central bank as well as the government, how they've kind of reversed the cycle to an extent. What does that mean for anticipated earnings recovery in FY26 and how our valuations look?
Hi. So I guess we are seeing earnings downgrade cycle for almost a year now for financials, and we've been cautious in general because we were expecting credit quality driven earnings downgrade, which are still happening. Uh, Incrementally, also our earning estimates are lower than the consensus, mainly because we feel a bit of credit cost is still to come versus growth expectations also clearly in consensus numbers are slightly more benign. Uh, if you look at the earnings downgrade cycle, if the measures taken by the government and RBI starts, showing results in the first half of, next financials, we might see some upside in earnings trajectory. Otherwise, if you look at the construct of P&L for banks especially, you would see that with the repo cut, you will have margin declines, which would put pressure on PPOP. And therefore, if you look at the consensus earnings even today, which are higher than our estimates, they are still in single digits for most players. So that is what I think is in the numbers. In terms of valuations, yes, because the sector has been derating for quite some time, the valuations look reasonable, and we need to see whether FY27 can be a recovery year. I don't think FY26 first half may not be, second half potentially. Yeah.
So, Vishal, let's get some of the numbers in. We're going to be ending FY25. I think the guess says is anywhere between, I think, 5 to 7%. It's been a bleak year. What do your numbers look like for FY26? Like you're saying, maybe the recovery is more back-ended. And then FY27, at least at the Nifty level, do we get back to double digits earnings growth?
I think that's for Gautam.
So,
Gautam, yeah. Gautam, why don't you take that?
I'll jump in. I think double-digit earnings growth for Nifty overall and markets overall in FY26, specifically given off a low base in FY25, should be a very reasonable expectation. And we do expect that to happen, including for the next couple of years. And as I said, look, the macro cycle itself, FY25 was a macro tightening cycle. FY26 is a macro easing cycle, both from RBI as well as central government. So that should be enough to have double-digit Nifty earnings growth.
Got that. Vishal, on banks and financials, I mean, actually it's been largely pretty tough, right? Accidents in banks, I mean, IndusInd is a case in point. MFIs has had a tough few quarters. NBFCs in many cases, I mean, it's not really made a lot of money except maybe a few. Gold Finances perhaps is an exception. So largely a tough environment. Even though the view has been that it's a defensive space, valuations have been reasonable, and this has been true for the last, I think, almost at least 3-4 quarters now. Do you think money will be made here? And what are your top ideas in this space, Vishal?
Sure. So I think, as I was alluding to, that the earnings downgrade cycle, it's been there for last almost 4 quarters. We could be probably towards the end of earnings downgrade cycle, but I think little too early to preempt because RBI announced a few things, the tax break, all these things generally should be positive. But on the ground, the data we see, it's not showing full recovery. Even if you look at today, the credit growth, loan, the deposit growth numbers are still, 10-11%. Liquidity is extremely tight, probably also because of advance, taxes. But we need to have easy liquidity once again and recovery on the ground. The data we track on delinquencies, overdues, that also says that stress is not over yet. And therefore, I think it's worth watching the space for the time being. In terms of the subsegments we like large private sector banks. We continue to like them. We feel that the sustainable earnings growth of 14-15%.
But my question is, do you like them on an absolute basis, thumping the table and say, well, buy them? Or this is like you make a nice portfolio and you put some banks there. Nothing wrong with it, but is it an absolute call, absolute return call?
See, thumping the table, valuations are not come yet, and therefore it is a relative call.
Got it. Fair enough.
Even financials, I'm actually, if I could jump in, I'm a little surprised because large banks specifically, Vishal, they've been underperforming throughout the last phase of the bull market. But you still think that thumping the table valuations on large India financials have not yet happened?
See, I think maybe the definitions are different for thumping the table.
Maybe
but let me clarify. let me clarify. So a 15% to 18% return is still doable because they are generating good ROA and ROE. I would say 25-30% is a thumping the table, kind of valuation or upside. So.
No, absolutely. Point taken. We've got so much to discuss, so let's move the conversation along. Gautam, another sort of constant feature in this market has been more and more competition in wherever there is profits to be made, right? I mean, profit pools getting disrupted, at least in the future. Cables and wires, for example, right? A news story, 2 hits back-to-back, announcements from large conglomerates making an entry, large business groups making an entry. What's the view there, and what's the feedback that you're picking up? Any outright buys after the sell-off?
Look, any sector where competition increases does cause concern, both stocks as well as incumbents. But there are 2 things to look out for when we look at the framework for these scenarios. One is the level of unorganized sector versus the organized. So if a new player is entering, it's more likely to disrupt the unorganized or also organized in a material way. That's the first framework. And the second framework is the time scale. How easy to disrupt in the next 3 years versus will it take 10 years? Like the role of distribution, the role of understanding the network, everything. Okay. So if you look at cables and wires specifically, we do see some impact. But again, after the correction, the sector overall does look attractive risk reward for us from our analyst perspective. That's the framework we'll put it.
Okay, so that's cables and wires, and you're still keeping the faith despite all the, the worries about competition. Gautam, another space, and I want to get your thoughts overall on PSUs and then defense. And the question really is whether the old leaders can continue to have a place in this leg of the bull market, if you're saying the bottom is in place, and if we are in one. Because I remember you folks came out with a call on HAL, and I think the view on that specific call was that the market's concerns are maybe a bit misplaced and orders will still coming in. So what's the wider view on defense and PSUs?
So before I get into defense and PSU, one simple market level point I would overlay in that discussion is I think 2025, as the market has bottomed and recovers, will be very different versus what we saw last couple of years, where thematics and sector-driven big moves happened. This year will be, even within sectors, a lot of differentiation for stocks. Like you heard from Vishal, financials also is not just one simple basket. There are pockets which will do well, pockets which still are seeing stress and will take time. Same thing applies on PSUs and defense. So we don't have PSU basket as such, but all the relevant PSU sectors. So it won't be a thematic run for PSUs and defense. But within that, and it applies to even CapEx or consumption, we see specific stocks which are attractively valued now on a relative basis versus where they were a year back, or even versus where they were pre-COVID, and where we have strong visibility on catalyst and growth, not just for the next 6-12 months, but for the next 3-5 years. So wherever we have that visibility and comfort, then yes. But the broader sector thematic, that strategy will not work in 25, unlike last 2-3 years.
But you are seeing some of those opportunities in defense.
Absolutely.
And where else in PSUs? Like defense, some defense names meet your criteria. Where else in PSUs do you still see valuations, growth, etc.?
So more than valuation, growth specifically across, there's opportunities in the utility space, defense, even financials, a little bit here and there, like segments of financials which are catering to particular sectors in the non-bank PSU space. Again, there are opportunities, absolutely.
I think in your published notes, HAL comes up as an idea, right? And I think oil marketing is another pack.
I can't comment on individual names, but yeah, oil marketing in general looks interesting, specifically given where the crude outlook also is.
Yeah, absolutely. I just want to make one point, Gautam, and Vishal said that he's still not seeing when banks are essentially front-facing or economy-facing, right? So it gives you a real good picture of what's happening. And this ties into the earnings growth point that he made. He said, well, credit growth is pretty sluggish. still very sluggish. Maybe it'll pick up as some of the RBI measures start to work their way through the system. Is that the view, Gautam, the team, that it will happen? I mean, it's a H2 story in that sense.
It will happen again. And then you look at global economies or Indian economy historically, credit growth doesn't drive or lead a recovery. Credit growth typically follows with a lag. There is activity picks up, and with the activity pickup, there is demand for more credit, and that's how credit picks up, not the other way around. The conditions for the demand and credit pickup has to be there. The condition for demand is the broader economic pickup, and for that to be supported by credit growth, there has to be sufficient liquidity in the system.
Okay, let's talk about a few other spaces. IT services, Gautam. Again, I mean, we all know the news flow and headwinds, etc., which are well advertised. But what's the view now? The team at the UBS and the analysts at UBS. What are some of the ideas where you have comfort and one can make money? Go on.
Yeah. So again, that's a space where the overall macro is quite double-edged, if I use the word. There are elements which can surprise positively if the US growth picks up and spending picks up. But given where the valuations, etc., you have to be very, very selective. So we won't go out and say, okay, you overweight IT and go out in a big way, but also not so it's more of a neutralish call on the sector overall. But there are pockets, again, just like most sectors, where we have interesting buy ideas.
Vishal, I just want to circle back to financials for a bit, and we take your cautious approach on board. So really, you said you still like some of the large banks. Beyond that, let's talk about diversified financials. And there's so much going on. Look at the insurance space. There's almost a deal a day over there right now. And there's too much of regulatory change. There's the entire capital market space where prices have come off significantly. So do you see opportunities there? Let's take these two pockets first, insurance and capital markets.
Yeah, see, so on both this, especially capital markets first. Now, we have seen blockbuster years, right? Last 2 years. In terms of activity, in terms of all revenue, EPS. So we are probably seeing like I don't want to say best is behind, but it's almost like there was a great momentum for capital markets player. In the very near term, maybe it just consolidates or slows down. We are structurally positive on capital markets, like exchanges and other ancillary players in capital market which we cover. So we think there is a great structural opportunity in this place. It's just that one needs to be sure about the near-term slowdown or consolidation, which we are already seeing, right, in some sense.
That's capital markets. What about insurance? And what do these recent deals imply for overall interest and valuations in that space?
I think that space is also consolidating in terms of growth, right? And therefore, we have seen the consolidation in valuation. We don't have very strong, bull or bear view there on insurance. We feel that, it's a sector which, again, especially the under-penetration of protection will keep driving growth over there. And savings is the bit which keeps, the volumes moving. Yeah.
So let me ask you a more general question on NBFCs. Now, the fact that there is better liquidity, slightly easier norms, risk weights have been lowered, that's good overall for the NBFC space. But if I were to ask you to rank NBFCs in order of preference or priority, where one can expect better returns, how would you rank it? Let's say there are the housing finance companies, there are auto financiers. You could talk about the gold financiers. Again, they're a big deal coming in, private equity major coming in and thumping the table with some money. So tell us, NBFCs, what to pick and why are you convinced?
Sure. So let me give you the framework, about how we are thinking about NBFCs. First, like microfinance, we feel there are still pressures. Asset quality, headwinds are still there, especially given that few things are still, pending to be effectuated on the ground. Let's say the 3-lender norm. Plus, I'm assuming the situation in Karnataka, is still work in progress in our view. So microfinance currently, I think should be the bottom, in that table. Then I think if you think about consumption lending, which is unsecured lending or NBFCs who are, catering to those, there also we feel that there is still data is still suggesting, build up on the stress, in the sense it's not falling, like it's not improving anymore, not improving. It is staying where it was after increasing in terms of delinquencies. So that's also a segment there, we need to actually watch out for data. Then I think if we think about auto financials, I think auto financials is space we like. Again, selectively names depending on the valuations, but that is a space where at least you don't have so much problems as a microfinance or unsecured. It's slightly better place, and because they have fixed rate lending, they benefit the most from falling rates. So that is like one of the segment. We don't cover gold finance
Right.
as of now.
Okay. Got that. Just a couple of other sectors, and we'll round up the conversation. Gautam, on telecom, what's the view? We reported yesterday that the government help, which many were hoping for in terms of the AGR dues after the court said no, perhaps won't come. Does your view change, and what's the house view?
We haven't changed any view or our stock preferences. I think the industry looks still attractive overall, though we don't have buys across the sector. We have a mixed bag of recommendations across the sector, including telecom towers and telecom service providers. So it's a mixed view, but overall, the sector still looks attractive to us.
Okay. Gautam, if you can tell us what's the feedback from the global team at UBS, right? Because they'll be tracking all those tariffs, etc., much more closely than we are here. Is it going to be, will 2nd of April be a meaningful jolt to global growth? Because that is the channel through which India will get hurt, as you said, not directly.
So look, not just for India, even global equities is not priced in if it leads to slower global growth. So firstly, the impact of global tariff or these tariffs on global growth and the impact on markets, I think globally it's not priced in. That's our house view. Will it lead, what kind of tariffs will it happen on 2nd April is anyone's guess. How long they last and therefore the impact on global growth and recession, again, too early for us to comment. But if there are meaningful tariffs which continue for a prolonged period, it will definitely lead to a growth negative surprise globally. And
but does the team at UBS globally believe that it's an ideological issue? They're ready for some short-term pain. So, are they leaning towards that view? Or is the view that, well, they can't see the market sell off too much, so they'll reverse and they'll go pro-cyclical once again?
Even that is too premature, right? Because there's a second order effect, which is how do different economies and countries respond to those tariffs? So one is it's difficult to predict what US president does on 2nd April, both in terms of degree and quantum. Second is how do different economies and countries respond? Like if there's a big tariff on India on 2nd April, will India wait for the trade deal to be signed and do nothing? Or will India impose tariffs in retaliation immediately and continue the trade deal discussion? Will have very different implications. If that we extrapolate globally, it makes it even more messy than it is.
So to sum it all up, I want to go back to the optimism with which we started, because Gautam told us the bottom has definitely been made for this market. Gautam, so what's the base case view? Nifty either December 25 or 12 months, whichever horizon you're looking at. What's the base case expectation? And leave us with, say, the top 3 bets or the top 3 segments through which you can play this leg of the recovery and the resumption of the bull market, if I can call it that.
So look, firstly, the Nifty should compare to 22,000 levels, not necessarily 23,000 levels. That's where the bottom was made. From that, Nifty should end up this year. Will it be double-digit returns, single-digit returns? Again, too premature. And that's why I used the word tactical in the beginning. Bottom made. Bull market is there or not is too early to say that. But sector picks, irrespective of what happens, at least in a relative way, definitely, is private banks, as Vishal highlighted. Consumption names selectively again, because there are enough catalysts around pay commission coming up next year and the tax break we saw this year. And finally, very selective names around the industrial basket.
All right. Gentlemen, thank you very much for joining us here on this special program. And we'll touch base post-April. I think that is when we will really know what comes our way and in terms of whether tariffs are big, they'll sustain for a long time in the roadmap ahead. But it's interesting, nevertheless. The message is clear, not thematic, not narratives, not sectors, but individual stocks within these sort of, spaces and sectors which will do well and perform in 25. So you've got to be very selective. Let's slip into a quick commercial break here. We will get you our corporate interactions on the other side. So stay tuned, coming right up.
Welcome back. The beauty of being in a market where bulls are in control. Any dip that has been given has been lapped up and has moved to the high point of trade for the frontline index. But the more interesting move has come by on the IT pack. This morning, the IT index closed, or rather opened lower after having closed higher yesterday. This on account of the news that came in from Accenture. But from those lows, we've seen a big recovery in the IT stocks itself. And by virtue of the weight that they have on the index, look at names like Infosys, TCS, all of them have recovered anywhere between 3 to 4% from the lows and have contributed on the way up to the Nifty itself. Now Nifty, knocking at the doors of 23,300 itself. What this has done, however, is buoyed the sentiments in the broader markets as well. The mid-cap index, which opened about 0.3, 0.4% higher, now has extended its rally to about 1.7%. 600-point uptick is what we've seen, with the advanced decline lines now firmly in favor of advances by a wide margin. As you can see, the gaping distance between the green and the red lines, 2,100 stocks in the green for just about under 400 stocks in the red right now. So looking good for the market. Let's get in our corporate conversation. The first one on the show. We have PS Raja, who's the PS Raja Gopal Sastry, who's the Group CFO at Endurance Technologies, joining in. The stock doing up about 1.5% higher today. Good morning. The first thing that I want to ask about is the demand situation itself, because one of your bigger clients, Bajaj Auto, over the last couple of months, we've seen some pressure in two-wheeler sales. Has that had an impact on your order book? How does that, augur for you right now? What kind of order inflows are you targeting in the remainder of this year and all of next year, if you could give us a sense?
Good morning. Yes, even if you look at a month as late as February, we did see that the overall two-wheeler market was down by 4%. However, boosted by the exports of customers like Bajaj, who did very well in the export market. While the volumes are challenged, but we do not think that this is a long-term situation. I think it takes very little for the sentiment as far as the two-wheeler market is concerned to bounce back. And even small things as the new tax regime kicks in as per the latest announcements next year. And even when we see all our own expansion plans from a micro side, with all of them kicking in and the order books fast filling up, our new offerings, our high-tech offerings going into the market, I see that our outlook is very positive. And we also think that the market will not stay in the negative area as far as the demand is concerned for long. It won't be as big as the earlier 14%, 15%, but definitely it will be in a positive growth range as we go forward.
What about Europe, international, markets? They account for a fair amount of your sales as well. If you could give us the quantum and what's the outlook out there as well? Because, we've seen some struggles in the overseas market for the world right now.
Okay. There have been a lot of external factors which have been impacting the vehicle production in European and in the European market. And logically speaking, it was a geopolitical situation. It's some part of the demand which actually goes into US, which are impacted by the tariffs, and even the recent regulation by the US on the cyber security. But if you see, even as late as the last quarter, which we announced the results, we grew almost 21% year on year in terms of revenue and 27% in terms of EBITDA. And this is coming from years of preparation, where we have been investing very carefully on our capabilities, on people, on capacities also, which gives us a lot of flexibility and fungibility to cater to any kind of demand which comes our way. And we have been able to look at any car production, whether it is the internal combustion engines or the electric vehicles. We have been able to cater to that demand and thereby actually grow to this level. And going forward also with a good order book, almost 300 million of orders secured in the last 3 years, about 36 million of orders only this year, and the all-important acquisition which we did of a company called Stefferle, which was very well managed, highly profitable, and that's another 80 million of orders. I see that our outlook for in-European business is very strong, which, like you said, is about 25% of our total business. And this will be despite the situation in the market. And if the market unwinds, and we are seeing some good volume growth, and we will stand in the best possible way to gain from it.
One of your other important customers, KTM as well, had said that they are looking for some sort of restructuring and there should be some clarity in the month of March. We're towards the end of March right now. I mean, the last week is next week. Has there been any update here?
The bad news is behind us. So they had asked for a restriction to the court. And as we saw the order from the court, there is a good support from the government to KTM for them to restart their operations. We are already receiving some schedules from them, and we do expect that they will bounce back, and it will go back to business as usual in the next 2 quarters or so.
What about the brakes business? You were looking to start this quarter. So what's the incremental potential revenue that you foresee from here, and has it started?
Brakes for two-wheelers we have been doing for quite some time. Both the foundation brakes and also the anti-lock braking systems, single channel, and we had developed the dual channel anti-lock braking system also. Interestingly, so we have received major orders for the dual channel braking system also in this quarter, which we will be serving going forward. From a two-wheeler business perspective, we have quite a lot of capacities which we had built, and all of them are getting filled up rapidly. And going forward also, we are getting over and above our major customer of Bajaj. We have been getting very good orders from the other customers like HMCL, HMSI, TVS, Yamaha. All of them have been giving orders to us in braking line. So we see good growth potential there, and with the help of our technical partnerships, we already have in place our ability to turn around new products, new offerings, and applicate them to the OEM's requirements with our own test track is also very good.
What does your order book currently stand at? If you could give us the absolute number.
If you look at year 2000, this financial year, we had about 780 crores of new orders, and 50% of those were for electric vehicles, around 40% were for four-wheelers. And I did mention about our expansion, which is in the Bidkin region of near Chhatrapati, Sambhajinagar, and also the Shendra region. Both the plants are quickly filling up their capacities. And the Shendra especially is for the four-wheeler market with some high specialty processes within the plant, which are required for the contemporary car models, and they would be exporting to some very important customers overseas. And added to that is that we are also very focused on our production capacities being eco-friendly, and this is a completely green building with zero fill to landfill and all the contemporary needs of an eco-friendly building. Now, as I spoke about the order receipts this year, we also have a pipeline of about 3,300 crores of orders received in the last 3-4 years, and majority of them will have their start of production in the upcoming years.
So that leaves us with the final question. What kind of revenue growth margins are you targeting in FY26?
Very strong, but I will not be able to give you a number exactly.
How do you define very strong? Let's put it that way. How do you define very strong? Margins in the third quarter were 12.5%. Do we see mid-teens, double-digit sort of revenue growth in FY26? What kind of profitability improvement that we see? Yeah.
I will have to give you a qualitative answer for that because we do not give quantitative forward-looking statements. Qualitatively, if you see even from the revenue, which grew 9% for the domestic business. We had a 17% increase in EBITDA, which was a good, strong margin expansion. So was the case with Europe. Even on a consolidated basis, for a 13% growth in revenue, I think we grew close to 19% in EBITDA. So we are looking at all our investments, both Europe, the Stefferle, and our investments in India, and also the new business acquisitions should give us good revenue growth. And as we see, we are very heavily focused on our operating efficiencies. We do see that we should see good margin expansions also going forward. And that's the way we are drafting our plans, and that's the way we are designing our businesses, while keeping an eye out for any kind of new business opportunities, both organically or inorganically. And as and when we have good maturity of any of those plans, we'll make public announcements of this.
That's fairly articulate. Thank you so much for giving us your vision for the next year as well. Wish you good luck for the next financial year. And we will have a conversation as and when you are able to, give us some more details when it comes to numbers and growth opportunities in organic or organic itself. That's Endurance Tech, stock up about 1.6%. The other stock on our radar right now is Bikaji Foods. Manoj Verma, who's the Chief Operating Officer at the company, joins in now. We're tracking the consumption space. We looked at it through the sale of two-wheelers and the suppliers to that. And now we're looking at it through, the sale of ethnic snacks too. The third quarter was marked by extremely high inflation in some of their key raw materials, including the likes of palm oil as well. Has that impacted performance in the fourth quarter? What's the outlook? Thanks a lot, Manoj, for joining in. That's really the first question. The fourth quarter, how has it been so far? Have you seen any moderation in input prices? I remember you said that you've taken price hikes of around 2.5% to 3% in the previous quarter, with a prognosis of about 1 to 1.5% in this quarter as well. All said and done, what does that mean for your margins in the fourth quarter?
So absolutely right. As we said that in quarter three, end of quarter three is what we took the price increase, and the benefit of that would reflect in quarter four. So certainly you will see drastic movement, upward movement in quarter three to quarter four in terms of the bottom line number. And that is on the basis of the price increase what we took.
So you typically target about 11.5 to 12% ex-PLI margins. Will you do that in the fourth quarter? Because the third quarter was just about 8%.
So yeah, so this was including PLI. So including PLI, yes, it will be ahead of that. But what we're seeing is that by end of quarter one is what we would normalize. So we'll come back to last year's quarter two level. So these two quarters, quarter four and quarter one, will get us to that level. So part of the increase, price increase, we have already taken in quarter three. And now a little bit we'll take in quarter one as well. So that's what is the plan.
What about volumes? The last quarter volumes were impacted by obviously a higher base. You had done away with some of the promotions, etc. The package sizes reduced. So the net volumes grew by about 3%. And you had a target of 13 to 15% volume growth for the entire year. Where do you stand on that number? And what kind of volume growth are you expecting in the fourth quarter?
What we said was about 12-13% of volume increase and the balance to the price increase. This is what was the plan. Now, this quarter, you will see, yes, the volume growth would be moving up. I mean, vis-a-vis if we look at the last quarter. So, yes, there will be improvement in this.
By how much?
So, 3 to 4% ahead of what we did last quarter.
Okay, so about 5 to 6% is what we can expect in the fourth quarter. What does that set you up in terms of targets for the next year, FY26? What kind of volume growth, price growth, and margin expansion are you expecting, if at all you are?
Yeah, so certainly yes. So for next year, what we are looking at double-digit volume growth, so somewhere around 11-12% kind of a volume growth, and we expect say 3% kind of a value increase. So that's what should take us around plus minus 15% in terms of value for next year.
And what about margins?
Margins, we will, so by end of quarter one next year, we will come to the normalized margin. So it's a PLI around 13.5% margin. And year on year, the plans are to increase, say, 50 basis points year on year for next couple of more years.
You know, when we speak to you, we speak through you about the industry as well. There's buzz of that deal taking place in the world of Haldiram's, right? I just wanted your thoughts on what do you make of the valuations, the reported numbers. valuing that company at around $10 billion. What kind of juice is there in a business like that? How much bigger are they compared to you all? And, what is the valuation differential? Because if that deal were to happen, that would change the scope of things for the entire ethnic snack space in the country. What have you heard on it? And what do you make of the numbers that are reported so far?
So we would also know as much as you guys have read and heard about it. Certainly, Haldiram, if you speak about, is multiple times bigger than what we are. But one thing I can say for sure that the stationery category and industry is certainly gaining eyes, and because the kind of growth what this category has witnessed, and because there's still a huge unorganized sector which leaves us with a room of growth in say next 3 to 4 years more. So that perhaps is the reason that the investors are getting attracted on this stuff.
How much bigger, according to you, would Haldiram be versus you? Your, trailing 12-month sales are close to around 2,500 crores. Would they be 3-4 times your size?
Putting both Haldiram as a brand together, certainly they should be around 4 times of what we are.
4 times of what you are. And 4 times of what you are basis what is reported so far, they would be, looking at closer to 8 times sales. Would you think at that level there would be, upside to this space itself?
Hopefully, yes. Let's see how. See, there are two different things. One is that how the valuations are, and second, how the business. So I think within company, what we concentrate more is on driving, the top line, bottom line, the rest of the things and stuff. And valuation is purely external matter, which perhaps is.
How are they any different from all the others in the space apart from the size? I mean, do they have better efficiencies when it comes to margins? Do they have better growth rates? If you could give us a sense of the difference between them and the others so as to one can make a comparison on your valuations versus theirs as well, along with all the others that are listed.
So two things certainly I can speak on. One, of course, with the size of the company. So the economy of scale comes in. So in terms of margin, definitely, in terms of procurement, other efficiencies would settle more in a larger organization. That's one. Second is the larger portfolio vis-a-vis most of the other competitors. So these two strong certainly things are. Besides, I assume that quality, though each other company would be concentrating or focusing on.
All right. Just a final question. With the money that they get, if at all they do you think, competition will increase for you and would make growth difficult for you, or will it continue to remain the way it is?
I don't see that way because this is not for the investment. I mean, this is purely the secondary stuff kind of a thing. So I don't think that would impact anything on the way the business is going in.
Wonderful, Manoj. Thank you so much. Always a pleasure speaking with you. Good luck for all of next year. 15% revenue growth, including 11 to 12% sort of volume growth, along with normalized margins by the second quarter is what you are guiding. 3 to 4% higher than previous quarter volumes for the fourth quarter, along with slump improvement versus what we saw in the third quarter when it comes to margins as well. That's Bikaji Foods stock marginally in the green, though it's still about 30% off its earlier highs. Good time to get in Mitesh Thakkar now for a quick technical check. Mitesh, a dip was given. Bulls lapped that up. The Nifty is up 60 points. What do you make of the markets right now? And any buy ideas?
So, Mangal, you've already put it. I think buy ideas. Yes, the direction remains on the upside. And I think you will get these kind of dips because we have had about 4 days of rally. The Nifty, if you look at it, starting from Monday's low, it's nearly done about 700 plus points. Similarly, the Bank Nifty, from the lows which it made on the 11th of March, it's done roughly about 2,400 points. So I think a pullback can always happen, but the directional bias remains on the upside. So use the stick lines to buy into it. On the stock side, NMDC is something, which is come into my radar. That's a buy with a stop just below levels of 66 for targets of around 71 to begin with, and I'm even looking at 74. So that gives you a good risk-reward equation over here. The other stock is ONGC, which I would recommend buying. The stop at 234.5 for targets of roughly around 248.
All right. Thank you so much for joining in, Mitesh. With that, we'll slip to a short break. On the other side, Manisha Gupta joins in with all the focus on everything that's moving in the commodities arena. Stay tuned.
Okay, welcome back. You've got the market, which is up 60 points, 23,250 is where we are at, and sort of nicely cruising along. And it's good to see that once again, despite a down day on Wall Street, despite this being a Friday, despite the fact that headline risk into the weekend is high, but is higher under the Trump administration, things are, looking pretty good. 5:1 in terms of advance to decline ratio. And, that means that there is a fair bit happening with volumes as well, which we'll refer to in a bit. But commodities, what's the action like? Manisha is here. Manisha, morning.
Morning, Prashant, and thank you for that. And, it almost seems like copper is telling gold, move aside, and it's me making all-time highs right now. That's exactly what we've done. So as the gold prices take a pause after that one-way rally, what is really running into the markets is the copper prices. If you look at the U.S. futures, they are trading at an all-time high of above $11,000 a ton. So while the U.S. has made all-time highs, LME still is waiting its turn. When you look at both of these markets, you could see the difference here. So the U.S. prices have gained up by 28% in this year, while the LME is up 15%. So when you look at both of these prices and the price disparity, it's easy to notice that the U.S. is trading at a premium of 13% over LME at this point in time. There are various reasons for this. Well, one is the U.S. dollar index is trading at a 5-month low. That has been a supportive factor. And apart from that, the U.S. Fed has signaled 0.5% of a rate cut by the end of this year. That in turn also has been supportive for many of these tangible commodities. And then it has been about tariff fears. I mean, that is something that's bothering all asset classes. And when you look at copper therein, well, Goldman Sachs and Citi have put out a report suggesting that they do anticipate that by the end of this year, 25% of import duties on copper could be put out from the U.S. markets there. Well, traders have redirected shipments from UK and Asian markets into US ahead of these potential tariffs. Also, when you look at overall market as a space, US does import 45% of its copper requirements. So that's the exact price reaction that you are seeing to those numbers there. Apart from that, it also is about the US copper itself seeing import of near record highs in the month of March itself. It is believed that 100 to 150,000 tons of copper could be coming into the US markets, and that's an all-time high number in the month itself. And then there's a lot of speculative trade also happening. The traders are covering their shorts. You have money managers deploying money into copper, and short positions also being covered. That has been supportive. Apart from that, there are shortage concerns as well. We do know that mining capacities have continued to decline, and even as there is conversation about increasing ore copper, that would take a few years. So this year and the next, the markets do believe you are going to be looking at higher copper prices continuing there. And then it also is about China, where they have been putting out statements suggesting that they will be buying a lot of tangible commodities. And 3 metals that they have put out a list suggesting is nickel, copper and cobalt. We've seen nickel prices continue to gain up. Copper prices trading at an all-time high. And when you look at the cobalt prices, well, that has surged by 49% in this year. So metals clearly trading in the green right now.
All right. Thank you very much with that update as far as commodities is concerned, of course. Keeping an eye on, some of the base metals, copper, as you pointed out. Time for a quick commercial break here, our special segment, Indianomics. My colleague Latha discusses, she's got 3 economists to talk about whether the rupee is out of the woods. The equity market seems like, fingers crossed, it is. What about the rupee? So Samiran Chakrabarti, Upasana Chachra and Shantanu Sengupta talk to Latha about it.
and welcome to Indianomics. I'm Lata Venkatesh. The Indian rupee has just done a U-turn. After falling by nearly 4% from November 24 to February, the Indian currency is up 1% in the past week and up 2% from its February 10th lows of 87.95 per dollar. One big reason for the rupee's recovery appears to be the February trade data, which showed a monthly trade surplus if you took goods and services together. Now, foreign portfolio outflows, especially on the equity front, have begun to thin down, but they still remain outflows. Has the rupee bottomed? Will India's current account deficit remain contained next year as well when tariffs loom? Will the net capital outflows turn into capital inflows in this calendar year? Now, that will also depend on India's growth trajectory. For a 360-degree perspective of growth, rupee and rates, I have with me an elite panel of economists, Samiran Chakrabarti of Citibank, Santanu Sengupta of Goldman Sachs, and Upasana Chachra of Morgan Stanley. Gentlemen and Upasana, thank you very much for your time. Samiran, let me start with you. You are quite convinced that this quarter, Jan, Feb, March, we will post a current account surplus?
Yes, Lata, that has been the trend for a while now in the last few years, when we are seeing this seasonal improvement in the current account for this fourth quarter of the fiscal year. So we think that that same trend will continue this year as well, and we should report a current account surplus for this quarter.
Okay. Santanu, what is your sense about this quarter, and more importantly, whether the deficit will remain contained in the coming quarter as well? Your thoughts?
Yeah, I would think that, as Samiran said, that, in the last couple of years, you've had this trend of this particular quarter driving into a current account surplus. So likely you'll have this in this quarter, but going forward, you'll have some expansion of the deficit. We still think that the external balances from the current account side is going to be relatively comfortable. You're still going to have a strong amount of services exports coming through. Your remittance inflows are good. So we would think that the current account deficit will be contained within 1% of GDP, probably a shade lower than 1% of GDP.
Okay. Upasana, the more difficult question has been capital flows. Y'all came out with a strong report on Indian equities and Indian growth. Is there any internal estimate on whether the capital outflows will thin out and we may turn to inflows? If yes, when?
That's really a tough question to answer in terms of how capital flows can change. But I think at the margin, what we are sensing is that, and as you also pointed out from the data, that probably some amount of the bearishness from an equity investment perspective is finding a floor. There's more recognition that data is not deteriorating and at the margin improving for India macros, and policy is also moving in direction to support growth. So again, as you highlighted, the growth delta matters for India from a capital flows perspective, and I think there is reason to believe that the second half probably could be somewhere where we would see that growth delta looking better for India versus maybe other economies as well, and that could turn the capital flows picture as well for India.
Okay, no, I agree that the toughest question was for you. I mean, it's a difficult one to guess, but Samiran, would you I think in your recent report you have upped your forecast of rupee. Can you take us through your argument? You believe the rupee is now in a stronger patch than what you perceived a couple of months back?
So a few things have happened, Lata. One is that overall the DXY itself has come down quite substantially from around 108, 109 levels to more like 103, 104 levels now. The second is that because we had allowed a bit of currency depreciation, nominal depreciation, and the fact that our inflation has corrected very sharply has led to the overall 40-country INR RER now back to around the 102 mark, which is slightly lower than even the longer-term average has been on RER. So from a valuation perspective, rupee has moved into a much more fair valuation level than what it was even a few months back. And on top of it, this improvement in current account, the seasonal improvement in current account, and we are also hopeful that at some point of time, the capital flow picture will also improve, not just because of the portfolio flows turning, but also because the FDI repatriation outflow that we have seen being massive over the last couple of years, at some point of time, that will stop. So we are hopeful that for FY26, the net FDI number will look better than what it has been in the last couple of years. We're not yet expecting it to go back to historical trends, but at least some improvement on that front, along with a pickup in the portfolio equity flow, should make the current account look somewhat better, which could also be supportive of rupee. And last but not the least, Citi has a view that oil prices will come off quite materially in 2025, maybe even going towards $60 per barrel by end of the year. That will also be quite supportive for the currency.
Okay, so what's your currency range now, Samiran, as of March end, of course, which is just a few days away, and for year end?
So, I mean, the way to think about it is not just from a rupee dollar level, but from a more relative perspective. So the argument that I was giving was more of a relative argument. But we think that as the tariff picture becomes clearer after the reciprocal tariffs are introduced next month, we could see some retracement in dollar also going towards DXY, going towards 106 and all. So with that, maybe rupee also can move towards 87, 88 range. But compared to the relative nominal depreciation that we had seen in the last few months, I think that's behind us. The key challenge for RBI would remain that this very large forward book that it has got, how it brings it down to a normal level. So as and when the BOP situation improves, that will be, in my view, the primary objective of the RBI. The spot reserves are okay for now. That's enough for them to be able to control the currency in a narrow range.
Okay. Well, according to what dealers tell us, even at the moment, RBI is allowing the swap, the sell swaps, and they're selling, but they're buying more than they're selling. So it's a net buy figure, which we have even for last week. And of course, there is this buy-sell swaps, which they have pushed 3 years down the line. Maybe we will get more of that. Santanu, what is your sense in terms of where the dollar rupee can go by the end of the year? I know it's a little unfair given the tariff, overhang, but nevertheless, how much of a depreciation this year?
Yeah, and end of the year, Lata, is a long time out.
Yes.
with so much of uncertainty around. But we would think that in the near term of around the 3-month horizon, you hover around this 87.5, 86.5 to 87.5 kind of a mark, and get towards an 88 over a 3 to 6 month kind of horizon. In the long term, we have right now baked in a depreciation of around 2.5% odd, which takes you towards that 88, 89 kind of mark. A lot of uncertainties, obviously, regarding flows, not so much the current account side, but more on the capital account. I would just emphasize the point that the short forward book position that the RBI has is quite sizable, and therefore, whatever inflows you're getting through the course of the year and the role that you use in the forward book will be important in terms of the currency management. And again, from a spot reserves perspective, while you're looking comfortable, right now the respite that you're seeing in the rupee is also largely because the dollar has turned, and therefore your short positions that were the positioning that we're building up offshore has also probably lightened up. And it is therefore going to be the dollar trajectory which is going to matter for the dollar rupee pair in particular. But over the medium term, again, going back to the fundamentals, the current account looks very comfortable. If some of the flows are back, the RBI should be able to manage it. And you're not going to have the requirement for a large depreciation that you had in the previous 3 months, because your vol is right now much higher than what you had in the second half of last year. So the vol adjustment will also be lower through the course of this year.
No, I take your point that the Reserve Bank's NDF sell position, the forward sell position is overhang, as both you and Samiran point out. But there are these other positives, and perhaps the Reserve Bank will have some elbow room to kick that forward, as they have done with $20 billion of swaps. Upasana, your rupee view.
So in the near term, I would say it remains more range bound, of course, begging more clarity from the trade policy that we see on 2nd April. Beyond that, I think, as both Samiran and Shantanu have pointed out, it will depend on the DXY positioning as well. We do have a slight depreciation bias if I have to take the 9 to 12-month view, also in line with what we think probably the CNY could see in terms of some depreciation further in calendar year 25. And that could play a role as well. But the dynamics of the BOP probably are going to be more supportive, as are the inflation differentials. And again, from the worst in terms of the rupee is probably behind us, is how I view it as well.
Okay. So would you all go beyond the 88? The maximum I heard here is Shantanu saying at the most 89. At the height of the rupee depreciation, people were talking about 90 very freely. Now, even at the end of the year, you guys are only looking at 89. Upasana, what is the in-house view in Morgan Stanley, even if that's not your terrain? What are people talking about, 88 or 89 in the current year?
So for us, the peak for USD INR does go to 89. Yes, we don't go past that. And that's more like, 6 months out.
Okay, so on the rupee, the worst of the depreciation seems to be over, according to y'all. But much of the rupee fall was also because India's growth was perceived to be slower. After this break, we will ask you the growth questions and when capital flows will become positive. Bazaar viewers, you will be able to see the entire show after market hours today. For the moment, after the break, it will be Chartbusters for you.